Look at this. This is a grocery receipt. A few weeks ago, I was standing in line holding eggs, milk, cereal. Nothing crazy. And when the total popped up, I just stared at it for a second because it felt high. Not luxury steak dinner high. Just normal groceries high. Now here's the strange part. Every headline keeps saying inflation is cooling. It's coming down. The economy is stabilizing. So I'm standing there thinking, if inflation is coming down, why doesn't my grocery bill get the memo? Did eggs just not hear the news? Because this doesn't feel like prices easing. It feels like something quietly reset. And then I open my YouTube feed. And suddenly, it's everywhere. America is collapsing. The dollar is finished. The next financial crisis has begun. It's all over my screen. So which is it? If inflation is cooling, why doesn't life feel cheaper? And if everything is collapsing, why does the system still seem strangely intact? I remember standing there thinking, okay, either something much bigger is quietly building, or we're completely misreading what's actually shifting beneath us. Because when everyday life feels off, and the noise keeps getting louder, that's usually when the real story isn't on the surface. And that's where this gets interesting. And that confusion, it's not new. I used to think systems collapse in chaos, crashes, bank failures, headlines screaming crisis. But what if they don't? What if they just slowly stop matching everyday life? Because the first version of the modern American system, what I call USA 1.0, didn't explode either. After World War II in 1944, the dollar was tied to gold. Other currencies were tied to the dollar. For about 27 years, it worked. Then the math changed. The world needed more dollars. America didn't have enough gold. So in 1971, Nixon closed the gold window. Just like that, USA 1.0 failed. Not in flames, not in collapse. It quietly became unsustainable. And that quiet shift reshaped everything. How money moves, why debt keeps growing, why markets can look calm even when something underneath is already shifting. That's what I want to talk about today. Because if the first system didn't collapse loudly, maybe what's changing now won't either. There was a time I honestly thought we were heading for another 2008, maybe worse, because that's the reference point, right? Housing crash, Lehman collapsing, markets freezing, people glued to CNBC. So when my grocery bill felt off, and debt headlines kept rising, and my feed kept filling with America is collapsing, my brain connected the dots. Okay, this must be how it starts, but something didn't fit. In 2008, things broke fast. Banks failed, credit froze, markets panicked. This time, markets still function, treasury auctions still clear, capital still runs into U.S. bonds whenever fear spikes. That doesn't look like collapse, so I went back. Before 1971, before the gold window closed, there wasn't some dramatic meltdown either. Life felt normal, but underneath, the mechanics were tightening. More global trade meant more dollars overseas. More dollars overseas meant more claims on U.S. gold. More claims on gold meant pressure on the fixed system. See the chain? Trade expands. Dollars spread. Gold gets constrained. Pressure builds. No explosion. Just tension. And eventually, the design couldn't scale, so it changed. USA 1.0 didn't collapse. It hit a structural limit, and that's the part I missed. I was looking for chaos, but sometimes the bigger shift is architectural. Debt rises, interest costs rise, fiscal pressure builds, rates rise, liquidity tightens, markets adjust, technology accelerates, labor shifts, capital reallocates. That's not panic. That's stress inside a system. So now, when I see dollar finished or system collapsing, I don't ignore it, but I ask something different. Is this breaking or is it stretching? Because collapse destroys, stretching redesigns. And if what we're seeing today is pressure building again, then the real story isn't fear, it's transition. And if the structure is shifting, where does the money go next? Okay, so here's where I had to reset my own definition. When people say, America is losing power, what are we actually measuring? Because I used to measure it the obvious way. Bigger military, bigger GDP, more aircraft carriers, higher stock market. That feels like power. But then I realized something. Power isn't about who looks strong. It's about who controls the wiring. Think about the global economy like a giant city. Power isn't who owns the tallest building. It's who owns the plumbing, who owns the water system, who owns the electrical grid. Because when something breaks, everyone runs to whoever controls that. That's power. Let's make this even simpler. Start with liquidity. When things get scary, where does money go? It goes into U.S. Treasuries. Not because investors wake up feeling patriotic, because it's deep. It's liquid. It's easy to enter, easy to exit. It's like the biggest, safest parking lot in town. When there's a storm, everyone pulls in. That's not symbolism. That's plumbing. Now technology. Not apps. Not social media. Infrastructure. Advanced chips. Cloud servers. AI models. Payment systems. If tomorrow you cut a country off from high-end semiconductors, how much slows down? Factories. Defense systems. Data centers. That's not a military invasion. That's control of the bottleneck. It's like owning the toll booth on a highway. You don't need to own every car. You just own the gate. Then there are the rules. This one is quiet, but powerful. Who writes the contracts everyone else signs? Who controls the settlement layer behind global trade? Who can freeze assets with a legal order? Sanctions only work if the financial system runs through you. That's rule-setting power. And here's the moment it clicked for me. Power isn't the fireworks. It's the framework. It's not who shouts the loudest. It's who sets the defaults. And here's something uncomfortable. Money is not patriotic. Money does not care about flags. Money cares about access. Imagine your local ATM stops working. You don't care about the brand on the building. You care about one thing. Can I get my cash? If another bank across the street works, you walk across the street. Capital does the same thing. It doesn't ask who deserves loyalty. It asks who provides access. Now look at today. Rates rise. Interest costs rise. The government issues more debt. More debt means more treasuries. More treasuries mean deeper liquidity. And when uncertainty rises, where does capital go? Back into that same pool. That's not emotion. That's structure. And that's when I realized something. I had been looking for collapse, for something dramatic, for something cinematic. But structural shifts are boring. They don't trend. No one makes a viral thumbnail that says incremental liquidity rebalancing. It's not sexy, but it's powerful. In the 1940s, power was gold-backed currency. In the 1970s, power was oil pricing and dollar liquidity. Today, it's chips, it's cloud, it's capital markets. Same concept, different layer. And when power shifts layers, capital shifts with it. So when someone says America is losing power, I don't ignore it, but I ask, losing which layer? Military or liquidity, GDP ranking, or technology choke points? Because those are very different conversations. And here's the sentence that changed how I see all of this. Money is not loyal to countries. Money is loyal to structure. If the structure feels safe, capital flows in. If the structure feels fragile, capital leaves. It's that simple. So the real question isn't, is America collapsing? It's this. Is the structure underneath getting weaker or being redesigned? And if it's being redesigned, where is the strongest structure forming next? Because wherever that is, that's where the money will go. And this is where things started feeling different to me. Not dramatic, not explosive, just tighter. I kept seeing headlines about the national debt hitting new highs. At first, that didn't shock me. The U.S. has had debt for decades. But then I noticed something else. The cost of that debt was rising. And that's when it stopped feeling abstract, because borrowing money isn't just about the total. It's about how expensive it is to carry. When rates were near zero, the debt felt manageable. When rates rise, the bill rises too. And that's not politics. That's math. I remember looking at how often the government has to roll over its debt. A lot of it doesn't last 30 years. It lasts a few years, sometimes much shorter, which means when rates go up, the impact shows up faster than people expect. That's when I paused, because higher rates don't just slow the economy, they make existing debt more expensive. And if more of the federal budget goes toward paying interest, there's less room for everything else. Defense, infrastructure, healthcare, education. Again, not ideology. Arithmetic. At the same time, markets were getting jumpy. Bond markets swinging more than usual. Investors demanding higher returns. Not panic, but unease. Then I noticed something else. For years, the Federal Reserve had been buying huge amounts of government debt, basically stepping in as a massive buyer that helped keep borrowing costs lower. But then, that support started fading. The central bank stopped adding to its holdings, and slowly it began shrinking them, which meant more of that debt had to be bought by private investors. That shift felt important, because when fewer big players are automatically buying, prices move differently. Demand matters more. Confidence matters more, and here's the part that really caught my attention. Every time there's global fear, money still runs into U.S. government bonds, even when people say the dollar system is ending, even when YouTube says collapse is coming. Capital still runs to safety. That contradiction stuck with me. If the system were truly breaking, why does everyone still run back into it during stress? That doesn't look like abandonment. It looks like strain. Then I layered in other signals. Gold quietly rising, countries building alternative payment systems, more trade being settled outside the dollar, technology concentrating power into fewer hands, artificial intelligence accelerating disruption, trade tensions rising, proxy conflicts simmering, insurance costs rising, borrowing costs rising. None of it screamed the end, but all of it felt like pressure, like the system was operating with less slack. And then I started thinking about politics. Spending can't be slashed overnight. Taxes can't be dramatically raised without backlash. Inflation can't be allowed to surge again. Growth can't be crushed either. There isn't infinite flexibility. That's constraint. And constrained systems behave differently. They become more reactive, more careful, more defensive. And when decision makers are operating with less room, they make different choices. Choices that affect where money flows, where investment goes, which industries get support, which ones don't. And once money flow shifts, structure shifts. That realization made me uncomfortable because this didn't feel like chaos. It felt like narrowing margins. The room for error was shrinking, and shrinking margins force redesign. Not because the system collapsed spectacularly, but because it can't afford to operate loosely anymore. Then I looked at the refinancing calendar again. A large amount of government debt has to be renewed in the next few years, not decades from now, soon. If borrowing stays expensive, the cost compounds, and if global growth slows at the same time, tax revenue softens, borrowing needs increase. Expenses don't magically shrink. That's when choices get harder, and harder choices create structural change, not always loudly, often quietly, behind closed doors, not in dramatic speeches, but in policy adjustments, capital allocation, regulatory shifts. When I stepped back and looked at all of it together, debt climbing, interest costs rising, central bank support fading, private investors demanding more yield, gold accumulation, parallel payment systems emerging, technology concentrating leverage, geopolitical friction increasing. It didn't scream collapse. It whispered compression, and compression inside a global reserve system is never random. It's mechanical. It builds slowly. It tightens. And then eventually, the framework adjusts. Not because it failed in one dramatic moment, but because the old setup can't comfortably support the new scale anymore. More debt, more technology, more trade, more interconnected risk. At some point, something shifts, and the more I looked at it, the less this felt like a crisis out of nowhere. The more it felt like accumulated pressure inside a system approaching its next redesign. And pressure doesn't always destroy systems. Sometimes it reshapes them. And this is where my thinking really changed. Up until this point, I was looking at the system like it was just reacting, like things were happening to it. But the more I paid attention, the more I realized there are people inside this. Real people. Making real decisions, under real pressure. Take the Federal Reserve. For a long time, I treated them like a switch. Rates up, rates down. Simple. But when I started listening more closely, it didn't sound simple at all. If they keep rates high too long, the economy slows harder, businesses pull back, hiring freezes, markets get nervous. But if they cut too soon, prices could start climbing again, And if that happens, people stop trusting them. That's not an easy spot to be in. Then I thought about the Treasury. They don't get to sit back and debate. They have bills to pay. Money has to go out. Debt has to be sold every single month. There's no pause. When borrowing gets more expensive, they adjust. They change timing. They shift the mix. They try to keep things steady. It's not dramatic, but it's constant. Then something else started standing out to me. Technology. At first, I didn't connect it to this story, but suddenly everything felt tied to chips, to AI, to data centers. And I realized this isn't just about inflation or rates. It's about positioning. Who controls what? Who builds what? Who supplies what? And when that changes, money follows. Then defense spending. Not tanks in the streets, just budgets shifting. Cybersecurity growing. Supply chains moving. Certain industries getting support. It all felt coordinated. Not perfect, but intentional. And then there are massive global investment funds. They don't panic. They don't react to headlines. They move slowly when they shift money into energy or infrastructure or technology. That matters. When I looked at all of that together, the Fed, the Treasury, tech companies, defense budgets, long-term global investors, it stopped feeling random. It felt tight, like everyone was trying to hold something steady while adjusting it at the same time. And that's uncomfortable because there isn't much room for error. At first, I kept thinking, just fix inflation. But then I stopped, because fixing inflation isn't free. If they push too hard, growth slows fast. Markets fall, confidence drops. But if they ease too quickly, prices could rise again. Long-term borrowing costs could jump. There's no easy button. And that's when I stopped asking, are they messing this up? And started asking, how narrow is the path they're walking? Because it doesn't look wide. It looks narrow, and narrow paths mean trade-offs. Not philosophical trade-offs, real ones, jobs, spending, credit, confidence. And when trade-offs get harder, decisions change. When decisions change, money moves differently. And when money moves differently, things slowly start to shift. Not overnight, not in one big explosion, just gradually, under pressure. That's what this feels like to me. Not collapse, not chaos. Pressure. A system trying to hold balance while the ground underneath it is moving. And the question that keeps circling in my head isn't, is it going to break? It's, how much pressure can it handle before something has to adjust? Because it doesn't feel loose anymore. It feels tight. And tight systems don't explode for no reason. They change. Sometimes quietly, sometimes slowly. But they change. And this is where it stopped feeling like pressure and started feeling like an argument. Because once I saw all these players moving, I realized they're not all trying to do the same thing. There are two very different instincts forming. No one says it out loud like this, but you can feel it. On one side, there's this voice that says, okay, the system is under pressure. Let's adjust it, but don't tear it down. Keep the dollar at the center. Keep global trade moving. Stay ahead in technology. Bring production closer to home. Use financial tools when necessary. In other words, fix what's cracking. Don't bulldoze the whole structure. And I understand that instinct, because for all its flaws, the dollar system still works. When fear hits, money still runs into it. So I gamble on something completely new. But then there's another instinct. And this one feels louder outside the US. It sounds more like, why should one country's currency sit at the center of everything? Why should global trade depend so heavily on one system? Why should financial sanctions carry that much power? Why should one central bank's decisions ripple across the entire world? That's where the talk about a multipolar world comes in. Countries expanding alliances, settling trade in their own currencies, buying more gold, building alternative payment systems, not loudly, not dramatically, just slowly creating options. And when I look at it that way, it doesn't feel like rebellion. It feels like hedging, like countries saying, we'll still use this system, but maybe we shouldn't rely on it completely. And that's where the tension really shows up, because if enough countries slowly diversify, the center weakens over time. But if the US tightens control too aggressively, that might push others to diversify even faster. It becomes a feedback loop. And I started picturing it like a strategy meeting. Not a dramatic war room, just a quiet, serious conversation. On one side, we double down, protect the dollar, strengthen tech leadership, reshore supply chains, stay in control. On the other, we reduce dependence, trade more regionally, build alternatives, accumulate reserves differently, create flexibility. Neither side sounds crazy. Both are reacting to the same pressure, but their solutions move in different directions. And that's what makes this moment interesting to me. The U.S. doesn't look like it's preparing to abandon the system. It looks like it's reinforcing it, investing in chip manufacturing, funding infrastructure, supporting key industries, monitoring financial flows more closely. That doesn't look like surrender, it looks like reinforcement. At the same time, other countries don't look like they're staging a dramatic exit. They're experimenting, testing new payment systems, making new trade agreements, adjusting reserves, no fireworks, just quiet shifts. So when I hear, the dollar is finished, or America is collapsing, it feels too clean, too simple, because what I see isn't demolition, it's negotiation, ongoing, unresolved. And here's the part that keeps turning in my head. If the U.S. strengthens its grip, does that stabilize the system? Or does it encourage others to build around it? If other countries slowly diversify, does that weaken the center, or does it just make the system more layered? No one seems ready to burn it down, but no one seems completely comfortable either. So maybe the real question isn't who wins. Maybe it's what does the next version actually look like? More controlled, more regional, still dollar-centered, but tighter, because whatever comes next, it probably won't arrive with one big announcement. It'll show up in small changes, policy tweaks, trade rules, capital moving differently, and that's what makes this feel different to me. Not explosive, but transitional. And if that's true, then the important question isn't whether the system survives, it's understanding how it shifts. And that's where this gets really interesting. And after staring at all of this for a while, 3 patterns kept showing up. Nothing complicated, just things I noticed repeating again and again. Pattern 1. Power at the center almost never disappears. It moves. For a long time, the center of power was energy. Oil routes, shipping lanes, energy supply. That shaped geopolitics for decades, but lately the center feels like it's shifting toward technology, semiconductors, artificial intelligence, cloud infrastructure, the places where data flows. That's where leverage seems to be concentrating now. So when people say power is fading somewhere, I'm not always convinced it's fading. Sometimes it's just relocating, quietly. Pattern 2. Money tends to move before the story appears. I've noticed this again and again. Prices shift a little. Capital flows change direction. Something feels slightly different. And only later do the headlines arrive. Almost like the explanation shows up after the move. It's not that the news is wrong. It's just slower. Markets react first. Narratives catch up later. So when something big is changing, the earliest signals often look small, almost boring, until suddenly they aren't. Pattern 3. Money usually flows toward whatever structure feels safest in that moment. Not forever, just for that phase. When risk feels high, money often hides in government bonds. When trust in currencies gets shaky, gold suddenly becomes interesting again. When growth looks exciting, capital rushes into technology companies. And when a new system starts forming, rare assets tend to attract attention. It's not emotional, it's structural. Money moves towards stability, wherever stability seems strongest. And when I put those 3 patterns together, something started to click for me. Power shifts, money moves early, and capital always searches for the safest structure, which raises a pretty interesting question. If the global system really is adjusting, where does that safe structure begin forming next? Because wherever that answer is, that's probably where money starts moving, long before the headlines explain why. But I should probably say this, because every time I start thinking about it this way, another thought shows up. A simple one. What if I'm wrong? What if things really do change in a bigger way this time? Because history does have moments like that. For a long time, everything looks stable. Then suddenly it isn't. So sometimes I ask myself something else. What if the dollar slowly loses some of its pull? Not overnight, but little by little. What if more countries decide they'd rather trade with each other using their own currencies? instead of always going through dollars? What if those payment networks people keep talking about actually start working? That's not impossible. And there's another possibility too. What if the world doesn't move to one new center at all? What if it just becomes more spread out? Different regions doing things their own way, different payment systems, different trade deals, different groups of countries working together. That kind of world would look very different from the one most of us grew up with. And honestly, I don't think anyone can completely rule that out, because every time I start feeling confident about where things might be heading, something new appears. A new policy, a new trade agreement, a new financial rule. And suddenly, the picture shifts again, which is why I keep coming back to the same question, not whether things are changing. That part seems pretty clear. The real question is, what kind of change this actually is? Because depending on how it plays out, the global economy 10 or 20 years from now might look very different from the one we're living in today. And honestly, I'm still trying to figure that part out. So, after digging into all of this, I keep coming back to one simple thought. Maybe the question isn't, is America collapsing? Because when you actually look around, nothing looks like a collapse. The economy is still running, companies are still growing, the dollar is still everywhere. But when I started looking a little closer, something else started to stand out. Debt. A lot of debt. Government debt. Corporate debt. Household debt. Layer after layer of it. And most of the time, we don't really think about that, because debt just sits there quietly. It gets rolled over, refinanced, pushed forward year after year, until one day you realize how much of the whole economy is built on top of those promises. That's the part that caught my attention. Not the politics, not the headlines, just the mechanics underneath, how the dollar system actually runs, who lends the money, who buys the debt, and what happens when those numbers start getting really big. So that's what I've been looking at next, not geopolitics, just the plumbing of the dollar economy, because the more I look at that side of things, the more interesting the story becomes. And honestly, I think that's where the next piece of this puzzle starts.